Hi all! Yes, it's been a while. Thanks so much for bearing with me the last 4 weeks as I took some time to deal with some personal family matters. The good news is that nothing really major happened during that time until last week when HR 7010 was passed by the Senate and then signed into law by President Trump last Friday. It's called the Paycheck Protection Flexibility Act of 2020, but I'm just going to call it the PPP because that's easier for the moment. It brought about several major changes. The first of which I want to talk about is in regards to the terms of the loan. Now, originally, anything that wasn't forgiven was going to be paid off in 2 years at 1%, and payment was deferred for 6 months from the date you received the funds. The problem with this is that because of the long processing time that we expect with the forgivability applications, people were going to start paying on these loans before their application for forgiveness was completely processed. So Congress has said, okay, new loans will be 5 years, 1%, and the payments will be deferred until your application for forgiveness has been completed. Now, there are a couple of things that we need to talk about here. And number one is the interest. So we know it's 1%, and we know it starts to accrue from the date it is deposited into your account. But we do not know if it is going to be forgiven. So you may have your PPP loan forgiven, but still be on the hook to pay the interest that was accrued. The other thing is a lot of you have already signed 2-year contracts with your banks for the PPP loan, and they are under no obligation to call you and renegotiate that. Furthermore, this bill doesn't suddenly retroactively change the terms of your loan. So if you would prefer a 5-year loan to a 2-year loan, you will need to contact your banks and see what you can do and negotiate with them, keeping in mind that I can't guarantee anything the banks are going to do. Now, the second major change is in terms of the amount of time we have to spend this money. Under the original terms, we had to spend this money within 8 weeks of receiving it up to June 30th. Because remember, the covered period for the PPP loan was February 15th of 2020 through June 30th of 2020. And this was causing a lot of problems and concern because a lot of my clients didn't actually receive the PPP loans until recently and certainly didn't have 8 weeks until June 30th. So we were working with them to apply these funds retroactively so that they were still using the funds within an 8-week period, but not going beyond the June 30th deadline. The problem with that is sometimes it's complicated, hard to understand, and hard to prove when we do that. So Congress fixed this by making it so that we have 24 weeks to use this money from when you receive it up through December 30th. So not only do we have a longer period of time to use it, but the period of covered time is much wider from February 15th through December 31st of 2020. So this is fantastic news. Now, the third thing I want to talk about is about the split. Yes, the split that they've drilled into our heads, the 75-25 split. We had to use at least 75% of this loan for it to be forgivable on qualified payroll expenses, but no more than 25% on qualified non-payroll expenses. And before I tell you what the change is, I want to make sure we define qualified expenses. So qualified payroll expenses include gross salaries and wages, healthcare and retirement benefits, paid leave, except for COVID-19 paid leave covered under the FMLA provisions for COVID-19 to be fully reimbursed to employers, as well as state and local taxes. The PPP was not intended to be used for FICA or FUDO. So if you used those funds on those items, they will not be forgiven or calculated into the proportion. So something to be careful about. Now, in terms of qualified non-payroll expenses that are forgivable, we're talking about mortgage interest, rent, and utilities. Now, qualified non-payroll expenses that are not forgivable is the debt interest we've been talking about. So the credit card interest, the line of credit interest, or any other capital interest outside of mortgage interest that you would be paying. So while that still factors into your 40% proportion, that interest expense itself is not going to be forgivable. You will have to pay that back. Now that we've defined that, the new rule is 60-40. At least 60% of the loan has to be used for payroll expenses, and no more than 40% can be used for non-payroll related expenses. Here's the rub. if you don't use at least 60% of the loan for payroll, you're going to be paying the entire thing back. Yes, that is correct. If you only do 59% for payroll, that means 100% of it will not be forgivable. So you're going to have to be super careful with that. Now, for the most part, FTEs and salaries and wages have not changed. They want your FTE levels to be at pre-pandemic levels, and they want your salaries and wages to drop no more than 25%. Now, originally, we could make adjustments for employees to whom you had given good faith offers to come back to work for the same hours and the same working wage, but refused to come back, or for employees that you terminated for cause. We could adjust them out of our calculations for both salaries and wages and FTEs. However, there have been some cases where employers have not been able to find qualified employees to fill spots, or they have not been able to ramp up their business operations to pre-pandemic levels, and that is affecting their FTEs and their salaries and wage levels. So we have now been told that in those cases, we can adjust those calculations to account for those lapses. So this is great news for a lot of people, and it certainly does cover a few gaps that were out there. Now, the other thing is if none of those qualify and you need to bring your FTEs or your salaries up, instead of having just until June 30th to make that fix, we now have well until December 31st to fix that. So if you need to hire people, adjust hours, do whatever we need to do to get those FTEs and salary and wage levels where they need to be, we now have until December 31st of 2020 to do that. So that's great news. However, there is one thing that you do need to know about, and that is if you have employees who are terminated for cause or refuse to come back to work, you are required to report them to your unemployment agency. For example, if you go to the VEC, the Virginia Employment Commission, you will see at the top there's a big banner that you can click on so that you can report those employees who chose not to come back or were terminated for cause. It is a requirement and you need to do it. Do not look at it as, a lot of employers kind of feel like they're ratting their employees out, but this is a federal requirement and you need to do it in order to look after the best interests of your business. Clearly, you definitely want to see where your former employees are coming from, but at the same time, you have a business to run. Now, another thing that is new and different with all of this is the federal taxes, and mostly I'm talking about Social Security here. Before, we still had to make those payments on time. Now they are saying we can defer them. I don't particularly like this idea because I work with clients on a daily basis that have not paid or deferred their taxes, and it's a very difficult hill to climb once you've slid down it. It's really hard to recover. It is one of the least expensive costs that you have in terms of like Social Security and Medicare, but it is the one that can get you in the most trouble and have the hardest time recovering from. So if you can, even if you can't use the PPP funds for these expenses, which you can't, I still want you to go ahead and make these payments on time. I don't think deferring them is helpful in most cases, or at least be talking to your accountants, CPAs, whoever you work with to see if that's even a good idea and how you adjust for that later, because you definitely don't want it to stay that way over the long term. Now, there is one thing that this act does not address that I need to bring to your attention. And that is, several weeks ago, the IRS gave us guidance about what is to happen to the expenses on which you spend these PPP funds. Now, the PPP itself is not a taxable event in that you do not have to declare it as income. But the IRS, in all its wisdom, has said, well, this is exempt income, so therefore the expenses you pay with that are not going to be tax-deductible expenses, which essentially undermines the entire point of the PPP in not making it a taxable event. Now, there are a lot of people who are saying the IRS is wrong. It's going to go to court. I know some senators have actually submitted a bill at the beginning of May to reverse the decision that has gained no traction as far as I can tell. But I have a feeling that's going to be changing, but it's still very important that you know that. And come tax time, you need to be talking to your tax preparers about whether or not those expenses are going to be tax deductible. Clearly, they are legitimate business expenses. It's just going to be a question as to whether or not we can claim them on your tax return. Okay, so that's the end of this video for now. The next video I'm going to be talking about all the ways you can get yourself in trouble with this PPP loan. So stay tuned for that. I'm going to try to get that out on Wednesday. In the meantime, please follow me on YouTube. Please go ahead and follow me on Facebook, Misty Lineberger at CPA, and I will make sure that I get these videos to you on a timely basis and hopefully answer some of your questions. Speaking of which, if you have questions, go ahead, list them below. Maybe I can get the answer into the next video. Thanks so much, everybody.